Hello and good afternoon, everyone. I'm Preeti Mishra and I head product marketing for the Treasury and Capital Markets vertical of Intellect Design Arena. I'm thrilled to have the opportunity to host you today. These are difficult times and I appreciate your presence in today's session. As you are aware that there is a regulatory push globally that firms should transition away from the LIBOR to alternative risk-free rates. This transition from LIBOR will mean considerable cost and risks for impacted enterprises. Maintaining the status quo is not an option. The strategy for migration should start in earnest to meet the deadlines. Intellect can help make a timely difference to your LIBOR migration strategy. How can we help? Welcome to the webinar on Smooth Transition from IBOR to Faster Adoption of RFRs. At the onset, let me quickly introduce my company. Intellect is a global leader in financial technology products with a full spectrum banking, capital markets, and insurance product suite for the digital age. We cater to 240 plus customers in 40 countries, covering central banks, commercial banks, brokers, insurance companies, asset management companies, and stock exchanges. Today's presenters are Mr. Venkatesh Srinivasan, Executive Vice President and Partner, Business Head for LIBOR Transition Solution at Intellect. Mr. Rohit Gajre, who's the Product Head for LIBOR Transition Solution at Intellect. Now, without any further ado, I would like to hand over to Rohit and Venkatesh.
Hello, welcome to our presentation on LIBOR transition using Intellect RFRCalc Service. I am Rohit Gajre, the Product Head for RFRCalc Service. I shall be taking you through today's presentation. The industry is well aware of the sunset of LIBOR rates in the coming months. Most LIBOR rates would cease publication post-2021. Some USD LIBOR tenors would cease publication post-June 2023. However, what is more important is no new contracts can be issued post-December 2021 with LIBOR as the benchmark. The new contracts would have to be benchmarked against the RFRs, the risk-free rates like SONIA or SOFR. Therefore, in today's presentation, we plan to discuss how technology can accelerate the LIBOR transition readiness. We plan to highlight some of the problems that banks will face in implementing RFRs. We'll focus on Intellect's offering, followed by a brief demonstration. We'll also discuss the key benefits of our offering and highlight one key success story. We see this transition as a technology implementation challenge. Current systems would require tweaking to process new RFR rates. However, this is complicated by the scale associated with LIBORs because they are entrenched across the bank. Further, the fast approaching December 21 deadline adds an element of urgency to the transition process. Being a regulatory change, the central bankers and local authorities too are invested in monitoring the progress of transition. As we will demonstrate, the variations in interest rate calculations are a key reason for systems complexity associated with this change. And these can best be addressed by incorporating an independent interest rate calculation module to the system so that we can isolate the RFR related changes in one single module. This is where the Intellect RFRCalc Service can help banks accelerate their RFR transition. There's another key challenge, the repapering of existing LIBOR contracts. They have to be changed to incorporate appropriate fallbacks so that you eliminate legal and financial risk. A manual approach to repapering is prohibitively expensive. Technology, specifically machine learning and AI, can offer compelling solution to the contract repapering problem. LIBOR transition impacts multiple asset classes: bonds, floating rate notes, loans, deposits, and derivative products. And these are impacted across firms, be it banks, insurance companies, asset managers, corporations, as well as financial institutions. The US and UK markets have already selected their LIBOR replacement benchmarks. The SOFR, secured overnight financing rate, would be the benchmark for dollars, and SONIA, sterling interbank index average, would be the benchmark for GBP. However, these RFRs are not equal to LIBOR, and they differ due to three characteristics: maturity, economics, and consistency. Maturity. RFRs are overnight rates, whereas LIBORs are published for 7 tenors, from overnight 1 month all the way to 12 months. Economics. RFRs bear negligible credit risk. LIBORs, however, incorporate credit risk associated with interbank borrowings and hence are higher. Consistency. LIBOR usage is standardized. However, RFR calculations vary due to differences in market conventions by asset classes, currency, as well as regulations. These differences have increased the complexity associated with system change due to RFR transition. We will now talk about the problems that we expect to see during the adoption to RFRs. There are two kinds of problems that banks will face: functional problems associated with the nature of the RFRs and system-related problems. We'll first talk about the functional problems. One key problem is to achieve the clarity of the average rates and the interest payouts. For example, most of the RFRs are published one business day after. So this brings a question: what rate do I accrue today? And hence there's a concept of lag, which talks about taking the rate from a previous business day or a couple of previous business days backward. Next, since the RFRs are overnight rates and we have to calculate the interest rate over a period of days, let's say 90 days or 180 days, we have to consider a way of averaging this. Now, in order to achieve that, there are multiple methods, be it payment delay, lockout, backward shift, and look back. These are arrears methods where you get clarity towards the end of the interest period. And there are advanced methods which give you clarity at the beginning of the interest period, okay, called last recent and last recent. Now, these methods have been evolved so that you can get clarity of the interest payment couple of days prior to the actual due date. Second problem: how do you get compounding rates? Now, if you go to the current situation with LIBORs, the rates are available at the beginning of the interest period. But in case of RFRs, they have to be discovered as the time progresses. And a lot of regulators talk about using compounded rates. Now, this compounding of rates happens via the OIS approach, where you compound the rate on business days, and on weekends and holidays you use simple interest. So this calculation is more involved vis-a-vis the earlier calculation, and this brings out complexities in day-to-day interest rate calculation. Third challenge is calculating the fair value of legacy contracts and deciding what rate is to be used for fallback. If you see here, this graph talks about the LIBOR rate, the lighter line, and the darker line, which is the 3-month average RFR, in this case SOFR. So you've seen that historically speaking, the LIBOR and the SOFRs differ, and typically speaking, LIBORs, since they include a credit risk component and a tenor risk component, they are higher than the RFRs, corresponding RFRs. And so if you are having a current LIBOR portfolio, when you move to the RFRs, you would have to make some credit adjustment, called as a spread adjustment. So technically speaking, the fallback LIBOR rate, fallback IBOR rate, is the sum of the average RFR rate and a spread adjustment. So this is something you have to keep in mind when we move ahead in the days to come. The final functional challenge that we envisage is the valuation of the RFR a fresh RFR contract on an ongoing basis. Now, in the current context, we have LIBOR rates. Could have LIBOR contracts which require you to have a forward curve for, say, the 3-month LIBOR or 6-month LIBOR. In the new context, we'll have to create forward curves as well as discount curves for the RFRs. So these curves will help you predict cash flows for your bonds, swaps, and then value them. The creation of these forward yield curves requires recalibration of models and rethinking of the principles involved in modeling. Finally, we'll talk about the system problems. So this is a technical issue where we noticed that in most cases, the core banking systems or your lending systems are customized to meet the bank's requirements, okay, for the bank's business use case or regulatory requirements. Now, if you have to move this, most of the vendors are pushing for a system upgrade. Now, if you go for a full system upgrade, this will make it very time consuming and possibly high risk and costly. So these are some of the key challenges that we envisage participants at banks to face in the coming days. We will now talk about why Intellect RFRCalc Service is important. The RFRCalc Service seamlessly operationalizes RFRs in financial products and renders fair valuation. It achieves this by minimal changes or configuration level changes in the products, thereby accelerating the pace of RFR transition. We'll now talk about some of the key features which are there before we go into the demo. So we've broken the RFRCalc service into 4 key modules. The RFR repository. This consists of the historical RFR and the LIBOR rates. Okay. It also has a provision for us to upload forward and discounting curves for valuation purposes. It shows you a tabular as well as graphical view of the historical rates, realized rates, and compares LIBOR and RFR rates, and an audit trail. The second module is very important from a domain perspective. It consists of the various market conventions and interest rate variations. We mentioned briefly about the various conventions like look back, backward shift, lockout, last reset, last recent. These are incorporated. Those models are understood and developed. The system has capability to provide you simple cumulative compounded rates as well as non-cumulative compounded rates for day-to-day accruals. There's also provision for flooring of rates where required. That is more important when the rates are negative. Further, it helps you in interest amount calculation and calculation of credit spreads. Third point, which is API. APIs are very important to the RFRCalc service, as this design is API driven, which allows the RFRCalc service to integrate very easily with your current systems, be it lending system or core system, and also access rates from upstream systems as a rate source. So this will provide you daily rates or be using whichever methodology you choose for correct interest accruals. And finally, there is the valuation module, which helps you calculate the economic impact of migration from LIBOR to RFR on legacy contracts. It also helps you in fair valuation of fresh RFR contracts. We will now talk about how the RFRCalc service can help us solve the customer problems. Let's talk about the first problem, getting the correct rates. The RFRCalc service determines the complex calculated rate using the averaging methods and incorporating the multiple convention options.
We've mentioned multiple times that the RFR regime will bring in a lot of complexity in the day-to-day interest calculations. This complexity is brought in by the variations in the methods which are eligible for RFRs, be it the averaging method, the compounding method. So getting the daily accrual right itself is a new aspect that we have to be prepared for. In order to achieve the day-to-day accruals, there are 2 industry methods. One is one of them is called the compound the balance method, and another is compound the rate. I will be illustrating both of these. and how they can be incorporated or implemented using the RFR calculator by Intellect. We'll first talk about the compound the balance method. For that, let's consider your RFR. For illustration purposes, I could select any of these RFRs. I am considering SOFR, which is a taller RFR. We are also selecting a day count convention, actual by 360. You could decide upon the rounding decimal places. Let's consider 4 for now. We mentioned about the various methods like look back, backward shift, last reset. We will consider look back for now. A look back method would involve a certain number of lag days. We will consider 5. And in this example, the RFR calculator can let you select other numbers as well, but we'll consider 5. A lockout is a suspension period in which you defer or don't consider the interest rate for the last n number of or last couple of days of the interest period. We will consider lockout to be 0 for now. Daily averaging as associated with the mechanism that you take to average, it could be compounded using the OS rule or simple average. We'll consider daily compounding. And now we are considering a loan which is starting from hypothetically from 22nd of February to 1st of March. So if you have to calculate the rate which has to be accrued on 22nd of February, the system tells you it is 0.05%. How is this calculated? This is the rate which was the SOFR 5 business days prior to 22nd of February, because we have selected 5 as lag. So, and that day happens to be 12th of February. So for 22nd February, we will be using the 12th February rate, which is 5 basis. Now we move to the second day. Second day would be 23rd February. Select, give the input, and the system will tell you the rate which needs to be accrued on 23rd February. Here you see it is 0.06% or 6 basis. And this happens to be the rate which was the SOFR on 16th of February. And this process will go on every day until the end of the loan. So for 24th, it is 6 basis. For 25th, it is 3 basis. And for the last day of the loan, for the last business day of the loan, it happens to be 2 basis. Okay. So what will happen is the RFR calculator will get the query, the API request from the product processor on a daily basis. The RFR calculator will simply give you the lag rate as per the look back method. And it is the responsibility of the product processor to take this rate, accrue interest on a daily basis, and compound the interest, okay, and get the correct accrual. This is the compound the balance approach. There is another method called as compound the rate approach. I'll illustrate that. Let us again configure the same particular loan here. I will go and select the parameters that we had decided from 22nd of February till 1st of March. Okay, I select the lag of 5 days. I take the look back method. I take, let's consider decimal precision of the highest possible. I'll take a principal of 100 million just to illustrate the numbers better. I will select the day count convention for loan, day count for the rate calculations. Actual by 360 is commonly used for SOFR. Click submit. And here you go. The system tells you the interest rate. And if you enable the NCR, this is a special property, the non-cumulative compounded rate. It tells you an NCR rate, 0.02000111%. So this number is a pre-compounded number. So earlier the numbers that we showed, which were provided, are numbers which need to be compounded at the product processor level. These numbers are pre-compounded, so they can simply be added to the or as multiplied with the principal to get the day-to-day accrual. So these two processes help the product processor get the correct accrual rate, so that you are able to accrue your interest on a daily basis correctly. Okay. We will now talk about some of the other features apart from the day-to-day rate operations, which the RFR calculation service provides, the accrued interest verifier screen, apart from giving you the NCR rate, also tells you the average rate for the period. In this case, it was the 3.71 basis approximately, and the interest amount. This interest amount considers the interest accrued on the RFR, the LIBOR, so the SOFR in this case, on the spread, and also on the credit adjustment spread. You will notice here that these calculations are sensitive to the various parameters. So in case I change the decimal precision from 9 to 4, you will notice that the amounts change. If I change the lag from 5-day to 2-day lag, again there is a change in the interest amount and the interest rate. If I change the method from look back to backward shift, again there are some changes. So and this is more visible, with higher precision. So the RFR rated interest amount calculation is sensitive to these changes in the conventions, and the verifier helps you check the correctness of accruals of your systems. Further, if you consider Ester, this is the rate for euros, you will notice that the rate is currently negative, around 50 basis negative. So the interest accrual on this would be low if you are not factoring the floor. The RFRCalc service has a floor adjustment. You can enable that, you could set the floor to a certain number. Let's consider 0. So in this case, since the daily rate of Ester is itself below 0 or negative, it's been floored at 0%, and you get the accrual accordingly. So this is a key feature which will be important for interest accruals, and this sort of calculation is supported by the RFRCalc service for verification purposes.
Now, moving on to the second problem, we realized that it is important to calculate or measure the credit spread between the RFR and the LIBOR, and possibly measure the impact of transitioning from LIBOR to RFR. The RFRCalc service can be used more broadly to calculate the spread, the credit adjustment spread, and also measure the economic impact of migration. RFRs and LIBORs differ not just in the term structure, but also in their credit risks. I am illustrating you the LIBOR and the RFR. In this case, I am showing you the 1 week GBP LIBOR, which is the curve in yellow, and the 1 week average SONIA, which is the curve in blue. You see that historically speaking, these are never perfectly equal. They go in step, but there's always a difference. And typically speaking, LIBORs are higher than RFRs. This is the credit risk element associated with the LIBORs. This is an important factor to consider when we are trying to price loans. This is true not just for legacy loans when you are transitioning from LIBOR to RFR, but also new loans or fresh RFR-based loans. RFR calculator has a functionality to help you calculate the economic impact of transitioning of loans, and also to do day-to-day valuation of RFR-based instruments. In order to do that, I will illustrate it via giving an example. Let us consider a yield curve for a particular day. These are the forward yield curves which are maintained in the system. I'll be taking a LIBOR GBP as example. So in the system, you'll see that we have maintained the yield curves for GBP LIBOR. You see that based in it's starting at a low level around 9 to 10 basis, and it is expected to go to around 1.2% by 5 years. There's also information about the SONIA forward maintained in the system. So this yield curve is close to 0 at present, but is expected to rise to 90 basis in 5 years' time. Similarly, there's a discount curve maintained. Here again, the discount curve is at a low level right now, but it's expected to go up. So using this forward curve information, we can now measure the impact analysis, economic impact of moving your current contract from GBP LIBOR to SONIA. We will take an illustration of a loan. So this is true for any kind of RFR contract. Loan is an example at this point. So let's assume there's a loan of around 100 million GBP pounds to a certain counterparty, which is maturing in another 3.5 to 4 years, say December 2024, and it is currently based on 6-month GBP LIBOR plus 4%. These are the current constraints, and it is proposed that sitting on March 2021, we propose that we move this from GBP LIBOR to SONIA with, say, a look-back method with a 5-day lag and a certain spread. Now, using the forward yield curve information and the loan template, the RFR calculator can predict or forecast a cash flow schedule. So here, based upon the information we have provided, the forward yield curves for LIBOR plus 4%. So you can calculate the expected coupons or the interest amounts. Similarly, using the RFR forward rates and the spread and the adjustment spread, you can predict the forward cash flows in the future. Now, once you have forecasted the cash flows, this can be discounted to the present value. So in this case, we have calculated the NPV as 100.6 million and 100.4 million, implying a notional loss of around 187,000 pounds on the revised contract, which is RFR based, SONIA based. So this is an important information which can be, which needs to be discussed with the client, and so that we can negotiate the appropriate credit adjustment spread, which needs to be added on top of the contract. Clearly, this 10 basis is not enough. It has to be higher. If you click on the solve button, the system also tells you the correct spread to be used. In this case, it is 15.0989 basis. So if you see that if you use 15 basis as the credit adjustment spread, your NPV becomes closer to, the NPV difference is close to 0. Hence, you're pricing these loans in a better manner compared to what it was being done earlier. This illustration was done using the web-based interface. There's an API-based interface which can be accessed so that the economic impact of transition for decision-making purposes, for negotiation with clients, can be done in bulk as well, as opposed to on a one by isolated basis, thereby helping you in correctly pricing your loans and performing the valuation. I will now show how we can value swaps and other RFR-based contracts using the valuation module of RFR calculator. We'll upload a SONIA swap detail like we did earlier. We'll click submit. We see that this swap, which has a maturity of around 6 years, the system was able to calculate the net present value of the fixed leg, the floating leg, and in this case, the floating leg had a higher value, around 335,000 positive, bringing us the value of the swap. We find that the valuation capability of the RFRCalc service can do valuation not only of the migration of loans and impact analysis, but on a ongoing basis also the valuation and NPV calculations of fresh contracts. This capability can be done not only via the web interface, but also via the APIs provided to automate and perform these calculations in bulk or in batch. We will now talk about the credit adjustment spread calculation feature of the RFRCalc service. This feature uses the historical median approach, which has been proposed by ISDA. What we see here is the calculation of the credit adjustment spread for dollars, USD, LIBOR vis-a-vis SOFR across different tenors. Here, each row represents the tenor of the LIBOR, overnight, 1 week, 1 month, all the way to 12 months. And this is the calculated spread. So here the spread calculation, the spread value increases with the tenor. So it was 60 basis for 12 months, 26 basis for 3 months, 3.7 basis for 1 week. This is based on historical median method approved by ISDA, It basically considers the median spread between the LIBOR, which is historical rate, and the RFR, which is a calculated rate, over a 5-year period using the backward shift method with a 2-day lag. With this particular configuration, this can be done for any other LIBOR as well, LIBOR RFR combination. So if you want to calculate it for SONIA with GBP, you need to select the particular rate and you will get it spread. So if you see here, it's around 46 basis for 12-month GBP vis-a-vis SONIA. The RFR calculator further allows you to change the method from look back to backward shift, change the lag number of days, and also the look back window. You could be lower than 5 years as well. How easy it is for us to integrate our current processing systems with the RFRCalc service. The RFRCalc service is based on an API design. Hence, it is very easy to couple with an existing system. So far, we have seen the screen or the UI based interaction with the RFRCalc service for getting rates, interest amount, as well as the economic impact. On a day-to-day basis, we envisage that this interaction between systems happen via the REST API provided by the RFRCalc service. This REST API allows for faster and simpler integration with product systems. This is an illustration of the same. Let's imagine this is a API request for SOFR for a period from 22nd February to 1st of March with a certain principal amount. The API request is sent and the system responds with the appropriate calculations, namely the NCR rate. It is 0.02000011%. It talks about the interest amount. So via the API, we will be able to get all of the information from the RFRCalc service, and it is a simpler way of integrating with product processors. In one of the earlier slides, we had talked about the challenges associated with upgrading a full system for RFR. Now, with the RFR calculator service, which is an API-based design, you can transition your current systems faster without requiring extensive changes and testing of the product processor. I'll illustrate it via the rates flow diagram. At the center is the RFRCalc service. On the right-hand side is the rates interface, which represents the trusted source, could be Bloomberg, Reuters, or such. On the left-hand side is the product processor, which we are trying to enable for RFRs. So the way our solution is designed, it exchanges the rate information via APIs. What it requires is the product processor to configure new benchmarks for the RFRs based upon the rate conventions and some more tweaking of the calculation logic. With these configuration level changes, the RFRCalc service will be able to provide the product processor with the correct accrual rate for day-to-day calculations, and thereby enabling the transition to RFR. The complexity associated with day counts with respect to averaging methods, to the compounding and the logic, etc., would not be brought into the product processor. That will be retained in the RFRCalc service, and we would still be able to enable the the transition, so that the change and the testing requirement will be drastically reduced, as opposed to a full upgrade of the system. So the RFRCalc service promises to enable a faster LIBOR transition with much lower risk and also lower cost. Intellect RFRCalc service offers significant value to customers, starting with the speed of implementation. It minimizes the changes to the existing bank systems and applications. It provides average rates based on several market conventions and averaging methods. This ensures faster RFR compliance by reducing the changes and the testing requirement across the system. It renders the fair valuation, calculates the impact on P&L because of migration. It helps calculate the fallback spread and valuation of RFR trades and portfolio-based contracts. It supports pricing and flexible risk projections using the advanced curve builder. A bank in UAE is our reference implementation site. Intellect RFRCalc Service helped the bank speed up its readiness in lending and borrowing applications with incoming ARRs. We delivered the change to the application within 2 months along with the RFRCalc service. We are also in advanced stages of upgrading our treasury solution in #1 global bank across 50 countries to comply with the new benchmark requirements. This brings us to the end of the demonstration. Thank you very much.